What's going on, everybody, and welcome back to yet another video. In today's video, I'm going to be helping you guys understand what your risk is in a trade, how to properly position, and to overall maximize your potential return. But real quick, as always, if you guys do find value in this video, make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. Without further ado, let's hop into the video. All right, so this should be a shorter video, but when it comes to understanding your risk in a trade, every single trade, your risk is likely going to be different. That's why I don't like the question when people ask me, how much do you risk in a given trade? Because every single time it's going to be different and I'm going to have to size differently. So let's just go ahead and let's look at this example right here. So looking at the ES futures, we can see that we had a very large aggressive move to the upside before price ended up dropping back down and making a higher low. Now, this is an actual trade that I ended up taking, and I want to talk about my thought process on how I went about position sizing and understanding what my risk was. So after this very large aggressive move up, when ES pulled back, SPY actually ended up hitting VWAP. So VWAP was up here on SPY. Plus on top of that, if we take a Fibonacci retracement from this pivot low to this pivot high, price did end up bouncing right off of that 50% retracement. So now when it comes to my entries, I am always looking for a bullish or bearish candle off of a key level. So because SPY came down, it hit the 50% retracement and it bounced off of VWAP. So as we pulled down towards that VWAP and that 50% retracement, this candle right here is what confirmed for me to get long. Now, once I find my confirmation candle, my stop loss is always on the opposite side of the confirmation candle. So because this was the candle that told me to enter long, my stop loss was going to be below this low right here. So if we go ahead and we take this long position tool, I was entering somewhere up here. Now, again, my stop loss was below this wick. So if you were trading futures, you were risking about 9 points, which is going to be 90 cents on SPY, give or take, maybe a little more because we have to actually break below that level. So now from here, you understand what your risk is. If we go on the opposite side of that confirmation candle and we show weakness below it, that is your point to get out of the trade. So, okay, you understand that your risk is about 9 points to 10 points, which is 90 cents to $1 on SPY. Now from here, it is up to you and how you position. Are you comfortable with potentially losing 9 points or 10 points? If you are, then cool, you can take the trade. But how many of these ES contracts can you take? If you can only lose $450 to $500, then you can only take one. Maybe you're willing to risk about 900 to 1,000. Well, then you can take two. But in this scenario, my stop loss was a little wider than I would typically like. So because the stop loss was higher, I'm not going to use as many contracts because the risk is wider. I had to use a smaller position to make up for the count that my stop loss was wider. Now, let's say you got a better entry in this scenario. Again, price pulls back, hits the 50% retracement, SPY hits VWAP. Maybe you ended up entering on this candle right here. Okay, well, if you entered at the close of this candle right here, you would still have to give yourself a stop loss right below here because, again, this was the candle that confirmed the trade. But now at this point, you're risking 7 points. So maybe you could take a little larger of a position because now you have about 2 to 3 points of wiggle room. Maybe you can add a little more contracts than you could have had you been risking that 9 to 10 points. Again, hopefully that's all making sense. Let's go ahead and let's look at another example. Let's say that you are looking to short this fair value gap right here. So we have this low and this high right there. There's our fair value gap. Price retraces into the fair value gap and it ends up rejecting it. Say you ended up getting short at the close of this 5-minute candle when it rejected the fair value gap. So if we end up taking the short position, our stop loss, again, the candle that confirmed the trade to get in was this one right here. So our stop loss is going to be right on the opposite side of that confirmation candle. You're not going to give it all the way through that fair value gap because now you're talking 12, 13 points. Your stop loss is always going to be on the opposite side of the candle that confirms to get into the trade. So now at this point, you're risking about 5 to 6 points, which is a lot better than 9 to 10 points. So now because your risk is smaller, you can use more contracts or more futures contracts to make up for having the tighter stop loss. So in the other scenario where you were risking 9 to 10 points, where you could only take 2 contracts if you were comfortable losing $900 to $1,000, well, if you're only risking about 5 points in this scenario, that's $250. So if you're willing to risk $1,000, well, now you can take 4 contracts in this scenario compared to this scenario over here where you could only take 2. So let's look at this last example over here. This isn't like an A+ setup, but it's still a setup that I could potentially take. As we see, we got a very large aggressive move to the upside. Price pulls back, it sets this higher low right here before then continuing higher. Well, on this pullback right here, we also have this 5-minute fair value gap. So if you like to trade fair value gaps, price came down, it bounced right off of it and gave a nice little lower wick. If you were to get long based off of this candle, this was the candle that confirmed to go long. So therefore, because this was the candle that told you to get into the trade, your stop loss is going to be right below the low of that candle. So in this scenario, you are risking 2 to 3 points, which is 20 to 30 cents on SPY, which is a very, very small stop loss. So because your risk is only 2 to 3 points, you can buy way more contracts than if you were willing to risk 10 points on the trade. So for every 1 contract you took for risking 10 points, you could take 5 contracts for risking 2 points. So the point that I'm trying to make in this video is your risk is going to be different in almost every single trade. Where's the confirmation candle and how far away is that stop loss going to be? Once you determine how far your stop loss is, that's when you can determine how many contracts you can buy. And again, look for price to trade to your key level, look for the confirmation candle, stop loss, always on the opposite side. But that is going to wrap up this video on how to calculate your size when trading as well as your stop loss. So if you guys did find value, as always, make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. Everybody have an amazing rest of your day. I'll see you guys in the next video.